Now it's about economics. Next audio, which is about inflation. Inflation is that state in which the prices of goods and services rise on the one hand and value of money falls on the other. When money circulation exceeds the production of goods and services, the state of inflation take place in the economy. Types of inflation we are going to talk about. So first one is demand pull up inflation. Inflation created and sustained by excess of aggregate demand for goods and services over the aggregate supply. In other words, demand pull up inflation takes place when increase in production lags behind the increase in money supply. Next one is cost push inflation, which is about inflation which is created and sustained by increase. So inflation which is created and sustained by increase in the cost of production, which is independent of the state of demand. We can say trade unions can bargain for higher wages and hence contribute to inflation. Stagflation is a condition of slow economic growth and relatively high unemployment. Economic stagnation, we can say that, accompanied by rising prices or decline in GDP. Usually, when unemployment is very high, spending declines, as do prices of goods. What is hyperinflation? Very rapid growth in the rate of inflation, in which money loses its value to the point where alternative mediums of exchange, such as barter or foreign currency, are commonly used, also called galloping inflation. So, galloping inflation and hyperinflation, somehow it's the same. Why is inflation is inflation bad? Almost everyone thinks inflation is evil, but it is not necessarily so. Inflation affects different people in different ways. It also depends on whether inflation is anticipated or unanticipated. If the inflation rate corresponds to what the majority of people are expecting or anticipated inflation, that then we can compensate and the cost is not high. For example, banks can vary their interest rates and workers can negotiate contracts that include automatic wage hikes as the price levels go up. Problems arise when there is unanticipated inflation. What happens when unanticipated inflation done? Creditors lose and debitors gain if the lender does not anticipate inflation correctly. For those who borrow, this is similar to getting an interest-free loan. Uncertainty about what will happen next. Then people living off a fixed income, such as retirees, see a decline in their purchasing power. Then the entire economy must absorb the repricing cost or menu cost as price lists. If the inflation rate is greater than that of the other countries, domestic products become less competitive. Measurement of inflation, when we talk about inflation is measured by Consumer Price Index, you can say CPI. This index measures changes in the average price of goods and services. A base year is selected, presently 2011 and 12 as 12, so it is, and its index is assumed as 100. And on this basis, price index for the current year is calculated. Inflation rate and the value of money or the purchasing power of money are inversely correlated. New Consumer Price Index CPI. The Reserve Bank of India since April 2014 has adopted the new Consumer Price Index combined as the key measure of inflation based on the recommendation of Urjit R. Patel Committee. Earlier, RBI have gave more weightage to wholesale price index than CPI as the key measure of inflation for all policy purposes. Now it's time to understand deflation. Deflation is that state in which the value of money rises and the prices of goods and services falls. The state of deflation may appear in the economy due to following reasons, like when the government withdraws money from the circulation, when government imposes heavy direct taxes or takes heavy loans from the public, voluntary or compulsory or both, when the central bank sells the securities in open market, which reduces the quantity of money in the circulation. When central bank controls the credit money and adopts various measures such as increase in CRR, credit rationing, and direct action. When the central bank increases the bank rate which curtails the quantity of credit in the economy. When state of our production excess supply for over demand takes place in the economy. Types of deficit: when we talk about fiscal deficit, primary deficit, revenue deficit, and budgetary deficit. So very first we will going to understand fiscal deficit. The difference between total revenue and total expenditure of the government is termed as fiscal deficit. It is an indication of the total borrowings needed by the government, while calculating the total revenue borrowings are not included. Generally, fiscal deficit takes place either due to revenue deficit or a major hike in capital expenditure. Capital expenditure is incurred to create long-term assets such as factories, buildings, and other development. A deficit is usually financed through borrowings from either the central bank of the country or raising money from the capital markets by issuing different instruments like treasury bills and bonds. When we talk about primary deficit is one of the parts of fiscal deficit. While fiscal deficit is the difference between total revenue and expenditure, primary deficit can be arrived by deducting interest payments from fiscal deficit. So it's important when you will get primary deficit when you deduct interest payments. Interest payments is the payment that a government makes on its borrowing to the creditors. Revenue deficit: a mismatch is in the expected revenue and expenditure can result in revenue deficit. Revenue deficit arises when the government's actual net receipts is lower than the projected receipts. It is termed as a revenue deficit does not mean actual loss of revenue. Let's take a hypothetical example. If a country expects a revenue receipts of rupees 100 and expenditure worth of rupees 75, it can result in net revenue of rupees 25. But the actual revenue of rupees 90 is realized and expenditure is rupees 70. This translates into net revenue of rupees 20, which is rupees 5 lesser than the budgeted net revenue and called a revenue deficit. Okay. The budgetary deficit, it is a difference between all receipts and expenses in both revenue, daily basis type, and capital account investments long run type or of the government. It is the sum of revenue account deficit and capital account deficit. Deficit financing is the technique. Deficit financing is the technique of the mobilizing resources through borrowings or printing currency when the revenue of government is not adequate to meet its expenditure. It leads to increase in the money supply, which leads to increase in price level in the absence of increase in supply of consumer goods quickly. Phillips curve. Phillips curves shows that inflation and unemployment have an inverse relationship. The theory states that with economic growth comes inflation, which in turn should lead to more jobs and less unemployment. Exception is stagflation, you can say. The inverse relationship between unemployment and inflation is depicted as a downward sloping concave curve with inflation on the y-axis and unemployment on the x-axis. Increasing inflation decreases unemployment and vice versa. Money supply. Now we are going to understand all the money held by with the public, RBI, as well as the government is called the total stock of money. Money supply is that part of this total stock of money which is with the public. By public we refer to the households, firms, local authorities, companies, etc. Thus, public money does not include the money held by the government and the money held as CRR with RBI and SLR with the commercial bank themselves. So it means, what is public money? Public money is public money. It means the money which we have in households, firms, local authorities, companies. It will not count government and RBI's SLR and CRR. Okay, then the reason of excluding the above two categories, SLR and CRR, from the money supply is that this money held by the government and RBI is out of circulation. Thus, we can conclude that the money in circulation is money supply. Okay, this money may be following forms: currency notes or coins. It might be demand deposits such as current saving bank deposits, time deposits such as fixed and recurring deposits, post office saving accounts, cash in hands except SLR, and deposits of banks and other banks RBI except CRR. In other way, this money has two components, viz. Currency components and deposit component. Currency components consists of all the coins and notes in the circulation, while deposit component is the money of the general public with the banks, which can be withdrawn by them using checks, withdrawals, and ATMs. Deposit can be either demand deposit or time deposits. Concepts of money supply. The Reserve Bank of India calculates the four concepts of money supply in India. They are called monetary aggregate or money stocks measure. They are M1, M2, M3, M4. So what are these? M1, money with the public, currency notes and coins, okay, plus demand deposits of banks. What are these? On current and saving bank deposit, plus other demand deposits with RBI. What is M2? M1 means what? M1 means money with public and plus a demand deposit of bank, okay, and plus other demand deposit with RBI. So M2 is what? M1 plus saving bank deposit with post office. M1 plus time deposits with the bank. M3 plus all deposits of post office. M1 measure represents the most liquid form of money or narrow money among the four money stock measure adopted by RBI. M3 is the most important component among all money stock measures, which is generally termed as broad money. So M1 is narrow money and M3 is broad money. Reserve money, or you can say M0. The other name of the reserve money is high powered money, base money, and central bank money. Reserve money denotes all the cash in the economy and is denoted by M0. It has the following components. Currency in circulation comprises currency with public and currency in hand with banks. Other deposits with RBI includes deposits from foreign central bank, multilateral institutions, financial institutions, and bankers deposit with RBI, mainly cash reserve ratio. Factors affecting money supply. Money supply is affected mainly by two factors: monetary base and money multiplier. Monetary base is what? As the reserve money changes, money supply also changes in the same direction. This means if there is more of reserve money in the system, money supply would increase and vice versa. Please note that the most of the changes in the money supply are due to changes in high powered money. High powered money means that reserve money, okay. Money multiplier is a ratio of the narrow money M1 or the broad money M3 to reserve money. Therefore M is equal to M1 oblique RM or M3 oblique RM. RM means reserve money. From the above, we note that supply of money is the product of money multiplier and amount of high powered money or reserve money. Flat money. What is flat money? Paper money or coins of little or no intrinsic value in themselves and not convertible into gold or silver, but made legal tender by fiat order of the government is called fiat money. It is the intrinsically worthless object such as paper money that is deemed to be money by law. For example, in India, rupee is the fiat money. A 1,000 rupee note is capable of buying goods and services worth rupees 1,000. Okay, although as such the note is nothing but a piece of paper. The value of fiat money is derived from the relationship between supply and demand rather than the value of the material that the money is made of. Historically, most currencies were based on commodity money such as gold or silver, but fiat money is based solely on faith. The first use of fiat money was recorded in China around 1000 AD. Since then, it has been used by almost all the countries now. Money is the most liquid asset because it is rapidly convertible into other assets. Immovable property is considered the least liquid asset. Money is what money does. Famous quote by Professor Walker. Okay, money is what money does. Cheap money policy and dear money policy. Cheap money policy is that monetary policy is which loans and advances are made available on low interest rates and easy terms to industries, businessmen, and consumers. Cheap money policy increases the inflation rate in the economy and it is generally adopted to get rid of deflationary tendencies in the economy. Okay. On the other hand, dear money policy is adopted to squeeze the credit utilization facilities in the economy. Under dear money policy, interest rate is increased. So, what is important? Cheap money in under cheap money policy, the interest rate going to low. Okay, and in dear money policy, interest rate is increased, which helps in controlling inflation in the economy. What is hot money? Hot money refers to short term funds coming from other countries to performing economies like India. In the context of international capital flows, hot money indicates funds from one country entering into the financial markets of other countries for a short term, expecting high returns. A major feature of hot money is that they are very short term. They are quickly moving from one market to another according to changes in risk and opportunities. The danger from hot money is that it is extremely volatile. This volatility creates instability in receiving countries like India, and flows and outflows of hot money in large quantity produce exchange rate fluctuations if there is high sum, and also potentiality impact a country's balance of payments and stock market boom and crashes. If hot money is into banks, the quick withdrawal may lead the bank into a crisis. Now it's time to understand difference between FDI and FII. Both FDI, foreign direct investment, and FII, foreign institutional investor, are related to investment in the foreign country, in a foreign country. FDI, or foreign direct investment, is an investment that a parent company makes in a foreign country. On the contrary, FII is an investment made by an investor in the markets of a foreign nation. In FII, the companies only need to get registered in the stock exchange to make investment, but FDI is quite different from it, as they invest in a foreign nation. FII is also known as hot money, as the investors have the liberty to sell it and take it back, but in FDI this is not possible. In simple words, FII can enter the stock market easily and also withdraw from it easily, but FDI cannot enter and exit that easily. This difference is what make nations to choose FDIs more than FIIs. FDI is more preferred to the FIIs, as they are considered to be most beneficial kind of foreign investment for the whole economy. FDI only target a specific enterprise. It aims to increase the enterprise capacity or productivity or changes in management control. In FDI, the capital inflow is translated into additional production. The FII investment flows only into the secondary market. FDI is considered to be more stable than FII. While the FDI flows into the primary market, the FII flows into secondary market. Foreign exchange reserve, FER. They are the assets held by or controlled by a central bank of any country and used to back its liabilities. For example, India's foreign exchange reserve held by RBI are made up of Foreign currency assets FCA, with you can say US dollar, euro, pound sterling, Canadian dollar, Australian dollar, Japanese yen, and etc. Gold, it might be a foreign exchange reserve. Special drawing rights, SDRs of IMF. What is SDRs? I'm going to explain. An international type of monetary reserve currency created by IMF in 1969, which operates as a supplement to the existing reserves of member countries, created in response to concerns about the limitations of gold and dollars as the sole means of settling international accounts. SDRs are designed to augment international liquidity by supplementing the standard reserve currencies. Reserve Tracking Position (RTP) in the International Monetary Fund (IMF), the proportion of the required quota of currency that each International Monetary Fund IMF member country must provide to the IMF but can designate for its own use. The reserve tracking portion, or you can say RTP. Okay, RTP of the quota can be accessed by the member nation at any time, whereas the rest of the members' quota is typically inaccessible. The level of forex reserve is expressed in US dollars, hence India's forex reserve declines when US dollars appreciates against major international currencies and vice versa. RBI gains foreign exchange reserves by buying foreign currency via intervention in the foreign exchange market, funding from International Bank for Reconstruction and Development IBRD, Asian Development Bank, International Development Association IDA, etc. Aid receipts and interest receipts. One very important scheme is there, gold monetization scheme. The gold monetization scheme, as introduced by government of India in 2015, aims to monetize gold as so that it earns interest. It is not a scheme in which government collects one's jewels and pays interests for the period and returns the same jewels that one has deposited. If one deposits it, what is it? If one deposits jewels, that will be converted and transformed into equivalent coins or bars and used by the bank. When one withdraws, he or she will get the equivalent money or the equivalent amount of gold coins or bars. Okay, so the basic objective of this scheme is to mobilize gold held by the households and institutions in the country and put them to productive use. The scheme aims to bring down the import of gold in the long term. The scheme provides the investor with the opportunity to earn interests on the amount of gold deposits. Gold in any form, bullion or jewelry, can be deposited. The minimum amount of gold which is accepted as a deposit is 30 grams. There is no upper limit for the deposition. The tenure for deposit has been distributed into three terms plans: short term 1 to 3 years, then medium term is 5 to 7 years, and long term 12 to 15 years. The investor is allowed to break the deposit during the lock in period by paying a penalty for premature withdrawal. What is BOP? That's really important. Balance of payment. The balance of payment records the transaction in goods, services and assets between residents of a country with the rest of the world or for a specified time period, typically a year. It represents a summation of countries' current demand and supply of the claims on foreign currencies and of foreign claims in the currencies. There are two main accounts of BOP: the current account and the capital account. The current account records export and import in goods, trade in services and transfer payments. And the capital account records all international purchases, sales of assets such as money, stocks, bonds. It includes foreign investments and loans also. What would happen if a country spends more than it receives from abroad? What would happen? He must finance the same money. What would happen if an individual spends more than his income? He must finance the same by the other means of, right? Then it may be by borrowing or by selling assets. The same way, if a country has a deficit in its current account, spending more abroad than it receives from sales to the rest of world, it must finance it by borrowing from abroad or selling assets. Thus, any current account deficit (CAD) is necessarily financed by a net capital flow inflow. BOP crisis, what is it? Countries with current account deficits can run into difficulties if the deficit is large and the economy is not able to attract enough inflows of foreign investments, then their currency reserves will dwindle. There may come a point when the country needs to seek emergency borrowings from institutions such as the International Monetary Fund. That may lead to external debt. Countries with deficits in their current account will build up increasing debt or see increased foreign ownership of their assets. BOT balance of trade. The balance of trade or trade balance is a part of balance of payment. So BOT is the balance of trade or trade balance is a part of balance of payment. BOT just includes the balance between export and import of goods. BOP not only adds the service trade but also many other components in the current account like transfer payments and capital account, FDI and loans also. Indian rupee is fully convertible only in the current account and not in the capital account. If an Indian investor earns interest or dividend in his investment abroad, that will be included in the current account of India. If FDI is done by an American company in the India, that investment will be accounted in the capital account of India. NRI deposits are calculated under a capital account while private remittances are calculated under current account. In general, national income is equal to private consumption expenditure plus investment plus government expenditure plus net exports. In a closed economy, savings is equal to investment. In an open economy, savings is equal to investment plus net exports, or net exports is equal to savings minus investment. This is actually the balance of trade or trade balance. India's top 10 exports, when we talk about gems, precious metals, first one, then second one, refined petroleum products, third one, vehicles, fourth one, machinery including computers, fifth one, pharmaceuticals, sixth one, organic chemicals, and many more. Okay, top 10 import, when we talk about, so first one, crude oil, second one, gems, precious metals, then third one, electrical machinery equipments, fourth one, machinery including computers, fifth one, organic chemicals. If we talk about India's top 10 trading partners, so United States, UAE, Hong Kong, China, United Kingdom, Singapore, Germany. Okay, taxation in India. Taxes are the government's way of earning an income which can be used for various projects. The Department of Revenue under the Ministry of Finance exercises control in respect of matter relating to all the direct and indirect taxes through two statutory body, namely Central Board of Direct Taxes (CBDT) and the Central Board of Indirect Taxes and Customs (CBIC). Types of taxes, when we talk about direct taxes and indirect taxes. So direct taxes are taxes that are paid directly. These taxes are levied directly on the entity or an individual and cannot be transferred on to anyone else. Examples of direct taxes are income tax, capital gains tax, security transaction tax, precipice tax, corporate tax. Okay, so what are these? When we talk about income tax, it is the tax that is levied on earning in the financial year. There are many facets to income tax, such as tax slabs, taxable income, tax deducted at resource, TDS, reduction of taxable income. The tax is applicable to both individual and companies. Then capital gain tax. This is a tax that is payable whenever one receives a sizable amount of money. It could be a form of investment or form of sale of property. Okay, it is usually of two types: short term capital gains okay, from investment held for less than 36 months, and long term capital gains from investment held for longer than 36 months. Security transaction tax, STT, and every time one buys or sells share, one has to pay this tax. All securities traded on the Indian stock exchange, stocks, futures, option, then mutual funds and exchange traded funds, have this tax attached to them. STT was implemented in October 2004. Then perquisite tax. Perquisites are all the perks or privileges that employers may extend to employees. Corporate tax. Corporate tax is the tax, income tax that is paid by companies from the revenue they earn. Wealth tax, which was also in the form of direct tax, was abolished in 2015. So there is no wealth tax. Indirect taxes are or those taxes that are levied on goods and services. They differ from direct taxes because they are not levied on a person who pays from directly to the government. They are instead levied on products and are collected by an intermediary, the person selling the products. These taxes are levied by adding them to the price of the service or product, which tends to push the cost of the product up. Example of indirect taxes: GST, goods and services tax. Let's talk about GST. It is a comparative indirect tax which has been levied on the manufacture, sale and consumption of goods and services in India with effect from July 1st, 2017. It was introduced as the 101st in Constitutional Amendment Act 2016, followed the passage of Constitutional 122nd Amendment Bill. GST was launched at the midnight of June 30, 2017 by President Pranab Mukherjee and Prime Minister Narendra Modi. The launch was marked by a historic midnight session of both of the houses of Parliament convened at the Central Hall of Parliament. It is the fifth midnight session that has been held by the Parliament, the other being the Declaration of India's Independence on August 1415, then Silver Jubilee of India's Independence, then 50th anniversary of Quit India movement on August 9, and then Golden Jubilee of India's Independence in 1997. The GST is governed by GST Council and its chairman is the Finance Minister of India. Under GST, and goods and services are taxed at the following rates: 0%, 5%, 12%, 18% and 28%. There is a special rate of 0.25% on rough, precious and semi-precious stones and 3% on gold. In addition, a sesh of 15% or other rates on top of 28%. GST applies on few items like aerated drinks, luxury cars and tobacco products. The central government has assured the states of compensation for any revenue loss incurred by them from the date of GST for a period of 5 years. GST is so far the biggest tax reform in the country. It eliminates the cascading effect of taxes because it is taxed at every point of business and the input credit is available in the value chain. France was the first country to introduce GST system in 1954. Since then, more than 140 countries have implemented the GST. Genesis of GST occurred during the previous NDA government under Atal Bihari Vajpayee government when it set up the Asim Das Gupta committee to design a model for GST. So that's really important. Asim Das Gupta committee is for designing of model of GST. Tax replaced by GST. You have a central excise duty, additional excise duties, service tax, additional custom duty known as special additional custom duty, then central surcharge or cesses. Among the state taxes, GST has some subsumed the following: state VAT, central sales tax, octroi and entry tax, entertainment and amusement tax, luxury tax, purchase tax, tax on advertisement, tax on lotteries, state surcharge and all commodity not under GST. So some commodities are there which are not under GST. These are potable alcohol, 5 petroleum products like petroleum crude, motor spirit, high speed diesel, natural gas and aviation turbine fuel, electricity. Tax havens. A tax haven is a country that offers foreign individuals and businesses little or no tax liability in a politically or economically stable environment. Tax havens also provide little or no financial information or to foreign tax authorities. Individual and businesses that do not reside in the tax haven take can take advantages of these countries tax regimes to avoid paying tax in their home countries. Andorra, the Bahamas, Belize, Bermuda, the British Virgin Island, the Cayman Island, the Channel Island, the Cook Island, then Hong Kong, the Isle of Man, Mauritius, Liechtenstein, Monaco, Panama, Switzerland, and St. Kitts and Nevis are all considered tax havens. However, pressure from foreign governments that want to collect all the taxes revenue they believe they are entitled to has caused some tax haven countries to sign tax information exchange agreements TIEAs and mutual legal assistance treaties MLAT that provide foreign governments with formally secret information about investors offshore accounts. The Organization for Economic Cooperation and Development (OECD) identifies three key factors in considering whether a jurisdiction is a tax haven. No or only nominal tax is there, protection of personal financial information, and lack of transparency is there. We talk about important features of GST. GST is value added tax. GST is destination based tax. States which consume more than manufacture will benefit. CGST and SGST to be simultaneously levied. Okay, CGST means center and SGST means state. Okay, then both states and center have a say in GST rates. Value added tax means what? VAT is the multi point destination based system of taxation which tax being levied on value addition at each stage of transaction in the production distribution chain. The term value addition implies the increase in the value of goods and services at each stage of production or transfer of goods and services. VAT is a tax on the final consumption of goods and services and it's ultimately borne by the consumer. Mode VAT. Mode VAT means modified value added tax was introduced in India 1986 and renamed as CEN VAT on April 1, 2000. Principally, there is no difference between the two. Laffer curve. What is Laffer curve? It shows the relationship between tax rates and amount of tax revenue collected by governments. The curve is used to illustrate that is the more an activity such as production is taxed, the less of it is generated. Likewise, the less an activity is taxed, the more of it is generated.